This is Macro Horizons, episode 373, Core Concentration, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 11th. And as we expect, the market will be closely following core CPI services, excluding OER and rent, we'll note that if you back out all the components of inflation that are increasing, things look fine. And that's just good central banking. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the most relevant macro data event came in the form of April's payrolls print. Here we saw headline payrolls increased by 115,000. That was compared to the 185,000 seen in March. It also far outpaced the market's expectations for a gain of 65,000. This marked the first back-to-back monthly gains in payrolls since May of last year. It's also worth noting that the two-month average change of the headline is 150,000, which is the highest since December of 2024. Within some of the details, we did see that the unemployment rate was unchanged on a rounded basis at 4.3%, but on an unrounded basis, it increased to 4.337 versus 4.256. So there was some marginal upward pressure on unemployment. This slightly higher unemployment rate also was coupled with a decline in the labor force participation rate, which currently stands at just 61.8%. That's the lowest since October 2021. Perhaps a more bond-friendly development within the payrolls report was the fact that nominal wages disappointed, increasing just 0.2% compared to the 0.3% consensus, and the year-over-year pace came in at 3.6% versus the forecast of 3.8%. Overall, we're comfortable with the characterization of the labor market remaining stable, although there have been some meaningful crosscurrents that suggest that we might be nearing an inflection point and should be wary of the downside risks for the labor market. That being said, clearly the market hasn't been trading it that way. The market has been emphasizing developments in the Middle East and the related moves in the energy sector. Oil continues to provide the key barometer for trading the potential fallout from the war in the Middle East, and with front-month WTI crude prices hovering slightly below $100 a barrel, we expect that the Treasury market will continue to take a significant amount of trading direction from the moves in energy. The week just passed also included the May Treasury refunding statement. Here, the most important development was that the Treasury Department retained the sentence that Treasury anticipates maintaining nominal coupon and floating rate auction sizes for at least the next several quarters. So in practical terms, that has led the market to favor a further delayed start to higher coupon auction sizes, and currently May 2027 appears to be the earliest potential for increases. Even when those occur, we suspect that they'll be concentrated in the front end. 2s, 5s, 3s, maybe 7s, and 10s, 20s, and 30s will be unchanged. For the time being, it remains the case that Besant is content to fund the deficit via Treasury bills, and the refunding statement did note that Treasury is monitoring SOMA purchases of bills and the growing demand for Treasury bills from the private sector. So, given this backdrop, we don't expect there to be any supply-related bond bearishness outside of a slight concession for next week's refunding.
While it was payrolls week, frankly, the price action in the Treasury market and the equity market and the mortgage market and the credit market were all driven by headlines surrounding the war in Iran, given the optimism that characterized the early week trading that Tehran was reviewing the U.S.'s proposal and a peace agreement that was going to be imminent, which ultimately gave way to headlines trending the other direction about the U.S. striking port infrastructure in Iran and hitting ships in the Strait of Hormuz in an effort to preserve the ongoing blockade. This took place with 10-year yields in familiar territory, call it between 430 and 440, and even after we got another impressive upside surprise in terms of NFP, with headline hiring coming in at 115,000 versus the 65,000 consensus, and an unemployment rate at 4.3%, with a slight downside surprise in average hourly earnings. It was another month with solid hiring and no signs yet of the detrimental impact on the labor market that we expect will ultimately follow the oil shock, which only serves to cement a steady rate outlook as Warsh prepares to take over as Fed chair and attention turns toward Treasury supply, CPI, and the quickly approaching June FOMC meeting. But for the time being, the blockade in the Persian Gulf, the war in Iran, and the price of oil remain the most important macro variables from the market's perspective, and we expect that's going to continue to be the case as we get further into May.
And while we do think that at some point there will come an inflection in which the market begins to de-emphasize the movements in the energy sector in favor of some of the fallout, whether that's evident in the macro data or other asset prices, equities, for example, for the foreseeable future, the direction of Treasury yields is by and large going to rely heavily on the direction of energy prices. We're also beginning to see an increase in concerns related to food cost inflation as a result of the lack of ship traffic coming out of the Persian Gulf, simply because as producers work through their current inventory, the elevated fertilizer costs, diesel costs, transportation costs are going to be factored into forward pricing as opposed to what is presently running through the system. So, with that backdrop, we continue to expect the Fed will remain on hold, certainly through the summer months. And while we struggle with the argument that the Fed's next move might be a rate hike, at the end of the day, we're very comfortable with the current pricing in the Fed funds futures market, which confirms investors' expectations for policy rate stability well into 2027.
And even though the jobs report was strong, basically no matter how you slice it, the one aspect of softness, namely the disappointment in average hourly earnings that came in at 0.2% versus the 0.3 expectation on a month-over-month basis, is the most important variable in evaluating the distribution of risk around the likelihood that Warsh will ultimately be forced to tighten monetary policy even from these levels. We've been talking about, hypothetically, the necessary conditions that would have to materialize in order to get the Fed more realistically entertaining the idea of a rate hike, and, along with a low unemployment rate and strong headline hiring, which obviously we saw in April's data, what would really be required to change the thinking around the potential for more demand-driven inflation, aka the type of higher consumer prices that the Fed would want to respond to, we would need to see that labor market strength flow through to realized wage gains. Higher wage gains equals higher consumption equals higher inflation and more robust growth. And so the fact that even with an unemployment rate at just 4.3%, which is extremely low by any historical measure, the fact that we're not seeing a spike in average hourly earnings and take-home pay increase commensurate with that labor market tightness is a very important difference versus the dynamic we saw on the other side of the pandemic. When labor demand spiked, the unemployment rate declined sharply, and wages increased as well. And so, from the Fed's perspective, a strong labor market with inflation risks tilted to the upside as a function of supply concerns in and of itself is not necessarily a reason to consider tighter monetary policy. It would only be if we start to see more concrete signs of a demand reacceleration that conversation would become more realistic. And so, as the market prepares for the transition to a Fed under new leadership, we're likely going to see a continued emphasis on data dependence and waiting and seeing, because even Warsh is not going to be cutting in June, and while that might upset the White House, as we learned from last week's 3 dissents, the incoming chair has plenty of convincing to do as it relates to the necessity for the next move to be a cut.
And while I generally agree with the argument that the April employment report sets the Fed up well to keep policy rates on hold over the summer, I will make the observation that it wasn't quite as universally strong as the headline might imply. In fact, we did see the unemployment rate on an unrounded basis move higher in April. It was 4.337 compared to March's level of 4.256. And this occurred with a decline in the labor force participation rate. Labor force participation moved 0.1% lower to 61.8%, and that's the lowest since October 2021. So this is very consistent with the notion that we're seeing workers step away from the employment market. It's also notable that within the household survey, the employment level declined 226,000 in April compared to the drop of 74,000 in March. This is the fourth consecutive negative print for the household survey's employment component. While we do tend to dismiss household versus the establishment survey, historically, when there is a divergence of this magnitude and persistence, it does tend to represent an inflection or a shift in the overall trajectory of the labor market. That being said, as the 115,000 job increase in April demonstrates, that inflection point hasn't been reached yet. And further to the point, the fact that the labor force participation rate is as low as it is, and we still see average hourly earnings only increasing 0.2%, suggests that it's certainly not a hot labor market. If anything, stability seems to be the best characterization.
And with all of this, even in terms of the price action and after the bearishness that we saw, which got tens briefly above 4.4%, we continue to trade this very well-defined range between, let's call it 4.2 and 4.4. Now, the breakdown in the moves between inflation expectations and real rates has been a bit more nuanced, as we saw 10-year break-evens reach effectively 2.5%, which is the highest they've been basically since the post-COVID period, or at least very close. And as nominal rates have climbed and break-evens have widened, we'll argue that the TIPS market is increasingly reflecting exactly the lower growth, higher inflation environment that investors are increasingly concerned about. And so, again, as we think about what the Fed is really worried about, in addition to the labor market and realized inflation, it's going to be especially topical to see how market-based measures of inflation expectations like break-evens, along with the survey-based ones, evolve over the course of the summer. And while, yes, we've seen crude prices stop climbing, they're nonetheless still at elevated levels, and that will operate, at least to an extent, to rebase inflation expectations higher. And so in breaking down the moves in treasuries, it is concerning to see that the expectation for higher inflation is starting to come at a more significant expense of the growth outlook.
It will also be interesting to see how things play out in the energy sector, because one of the big disconnects has been the fact that the oil futures market hasn't really reflected the cost of oil on the ground, particularly in Asia. To some extent, that is a function of the fact that many investors thought that the conflict would be relatively short-lived, and the inventory drawdown would provide the broader global economy a bit of a buffer from any persistent, significantly higher shock in energy costs. As the next few months unfold and inventories are drawn down further, it follows intuitively that there should be at least some degree of upward pressure for the front-month WTI contract, as well as the broader energy futures curve. The underlying question then becomes, how do other financial markets respond to this? Do we see a further acceleration towards higher break-evens? That much seems pretty intuitive at this point. Do we see equities begin to respond more negatively to the supply shock in energy? That's been one of the interesting wildcards, which, as we watch equities continue to push towards fresh record highs, strikes us as reinforcing the Fed's ability to wait and see if there's more durable fallout from the war in Iran, simply because elevated equity prices ease financial conditions and lessen some of the potential impact from monetary policy at current levels. Well, like they say, stocks up, moods up.
The dip. Buy it. Don't be it.
I don't get it. In the week ahead, the Treasury market will have a lot of fundamental inputs from which to derive trading direction. The biggest highlight will be Tuesday's release of CPI. The market is looking for a 0.6% increase in headline CPI and a 0.3% increase in core. Investors will be tracking the supercore measure of inflation. Recall that supercore is defined as CPI core services excluding OER and rent. And this has historically been the area in which the Fed has been most focused, as it represents the best gauge of the risk that we see higher wages translating into higher demand-driven inflation. There will be an increase in headline inflation. There will be some pass-through to core. But unless and until it trickles through to the supercore measure, the Fed can be justified in its wait-and-see approach because there could be potential downside for consumption. And on Thursday, the market will see the retail sales print for the month of April, and any evidence that the control group, which was stronger than expected in March, has started to moderate or even decline, will likely be a tradable event, as it represents evidence of some of the potential negatives for growth from the war in Iran. Let us not forget, we also have the May refunding auctions. Here, because of the timing of the week, with settlement coming on Friday, May 15th, everything's been moved forward slightly. So on Monday, we see the 3-year, which is $58 billion, and then Tuesday afternoon, we have the 10-year, which is $42 billion, and that will be followed by Wednesday afternoon's $25 billion long bonds. As a theme, we continue to expect that Treasury auctions will be reasonably well received. The one caveat is that auction performance is often more a reflection of the amount of volatility that there is in the market during the traditional setup period for the auction itself. So if we come in on Monday and developments over the weekend in the Middle East warrant a sharp response in the U.S. rates market, we could see a bit more lackluster auction participation in the week ahead. The counterpoint is that with rates at current levels, investors might be eager to use the liquidity provided by the auctions to lock in at relatively high nominal rates. And of course, the broader theme remains in place, and that theme is trading developments in the energy sector and as it relates to the war in the Middle East. We maintain that the longer the Strait of Hormuz is closed, the more potential economic damage will be done to the global economy. As it currently stands, it's difficult to envision a path to reopen the strait in the very near term, and as a result, we expect that there will be ongoing inflationary angst, which will, in practical terms, limit the degree to which any rally in the Treasury market can extend unless there is significant and compelling evidence that demand destruction has already started to take hold and that consumers are struggling even further with the weight of higher prices. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. With oil back above $100 per barrel, we're reminded of the pandemic when oil was trading at negative $40 a barrel and everyone was attempting to devise a way to fill their swimming pools with crude. All we can say is that a lot of people probably dodged a bullet with EPA by leaving those plans in the theoretical stage. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.